Right now, somewhere on the internet, there's a comment thread full of people telling each other to buy any stock with the word AI attached to it. Doesn't matter what the company actually does. Doesn't matter what they earn. Doesn't matter if they've ever turned a profit in their entire existence. Slap an AI label on the name, and suddenly retail investors are throwing money at it like it's a guaranteed lottery ticket. And look, I get it. AI is genuinely transforming entire industries. This isn't a video about whether artificial intelligence is real or important. It absolutely is. This is a video about something completely different. The gap between a technology being real and a stock being a good investment. Those are two separate questions, and right now, millions of people are answering the first one and assuming it automatically answers the second. My name is Colt, and today we're going to walk through exactly why so many people are about to lose serious money in AI stocks. Not because AI isn't real, but because the way most people are investing in it has almost nothing to do with sound financial decision-making. If you currently own any AI-related stock, or you're thinking about buying one, I need you to actually sit with this video before you make another move. Subscribe and hit that like button because this could genuinely save you from a painful lesson. Let's start with something that should sound familiar if you know any financial history, because we've watched this exact movie before, multiple times. In the late 1990s, the internet was genuinely revolutionary technology. Companies built around it would eventually change how the entire world communicates, shops, and works. The internet itself was completely real, and yet thousands of investors lost everything buying internet stocks during that exact period. Companies with no profits, no clear business model, sometimes barely any actual product, saw their stock prices increase by hundreds of percent simply because they had .com in their name. Then the bubble popped, and a huge percentage of those companies went to zero, completely worthless. Notice what happened there. The technology was real. The investing thesis around individual companies was often completely disconnected from reality. People confused being right about the technology with being right about the specific stock. This is exactly the setup happening right now with AI. The technology is genuinely transformative. I'm not arguing otherwise. But that doesn't mean every company wearing an AI label deserves your money. And it definitely doesn't mean the current prices on many of these stocks reflect anything close to their actual business fundamentals. So let's talk about what's actually happening with valuations right now. Because the numbers here are honestly staggering once you actually look at them instead of just feeling the hype. Remember the PE ratio we talked about before, the price to earnings ratio. The number that tells you how much you're paying for every dollar a company actually earns. The overall stock market has historically traded somewhere around 15 to 20 times earnings on average. Many AI-related stocks right now are trading at P ratios well above 50, in some cases above 100, and in certain extreme cases, companies with barely any profit at all are being valued in the tens of billions of dollars, based almost entirely on future expectations rather than current financial reality. Let me put this in concrete terms. If you buy a stock trading at 100 times earnings, you are essentially betting that the company's profits will grow dramatically for years into the future, fast enough to eventually justify what you're paying today. You're not investing in what the company is, you're investing in a very specific, very optimistic story about what the company might become. And here's the problem with that bet. Stories can be wrong, stories get revised. Stories collapse the moment growth slows down even slightly compared to expectations. This is exactly what crushed .com era stocks. It wasn't that the internet failed, it's that the prices people paid assumed a level of growth that was mathematically impossible to sustain for most of those companies. And the moment growth even slowed down, not stopped, just slowed, the stock prices collapsed because they were built on a story, not on earnings. Now here's something that should genuinely concern you about how people are currently buying AI stocks specifically. Separate from the valuation issue, most retail investors right now aren't actually doing any research into the companies they're buying. They're buying based on three things. The ticker symbol contains or relates to AI in some way. The stock has been going up recently, which feels like proof it's a good investment, even though past price movement tells you nothing about future price movement, and social media or online forums are excited about it. None of those three things have anything to do with whether a company is actually a good investment. None of them tell you about the company's actual revenue, its profit margins, its competitive position, whether it actually has a sustainable business model, or whether the current stock price has already priced in years of future growth that hasn't happened yet. Let me walk you through a hypothetical example that mirrors what's actually happening across the market right now. Because seeing the math laid out tends to hit differently than just hearing the concept. Imagine a company we'll call Neuraltech. Neuraltech makes some kind of AI-powered software product. It's a real company with real revenue, not a scam, not fraudulent, genuinely building something. Neuraltech currently earns $50 million in annual profit. Its stock is currently valued at a total market capitalization of $10 billion. Divide that market cap by the annual profit, and you get a PE ratio of 200. For that valuation to make sense, even loosely, Neuraltech would need to grow its profits dramatically over the coming years, sustained over a long period, just to bring that ratio down to something resembling a normal, historically supported valuation. That's not impossible. Some companies genuinely do this, but it requires an enormous amount of things to go right, consistently, for years. Competition has to stay manageable. The technology has to keep improving as expected. Customers have to keep adopting the product at the pace investors are betting on. Larger competitors with far more resources can't successfully build a better, cheaper version that steals the market. Any one of those assumptions breaking, even partially, and that $10 billion valuation built on a 200 PE ratio becomes very hard to justify. And when valuations become hard to justify, prices fall, sometimes dramatically. Sometimes most of the value disappears within months. This is exactly what's happening to a lot of stocks people are calling AI plays right now. Some of these companies will absolutely become the Amazons and Googles of this era. They'll justify their valuations and then some, eventually becoming generational wealth builders for early investors. But here's the uncomfortable truth nobody wants to say out loud. Nobody, including professional fund managers with decades of experience, can reliably tell you in advance which specific companies will be the long-term winners and which ones will collapse. The hype treats every AI stock as if it's already been determined to be a winner. The reality is that most speculative technology booms in history have produced a small number of massive winners and a large number of companies that lost most or all of their value. If you're buying broadly across AI stocks right now simply because they're AI stocks, you are statistically more likely to be buying into the large group of eventual losers than the small group of eventual winners, purely because the small group of winners is, by definition, small. So what should you actually be doing if you want exposure to this trend without gambling your money on a guess? Let's talk about real strategy here instead of just the warning, because that's actually the more useful part of this conversation. The first move is to separate your belief in the technology from your belief in any specific stock price. You can be completely correct that AI will transform the economy over the next decade and still be completely wrong about whether a specific company's stock is fairly priced today. These are two different judgments. Most people collapse them into one, and that's exactly where the mistake happens. The second move is to actually check the fundamentals before buying anything, the same way we talked about with the PE ratio in general investing. Look at actual revenue. Look at actual profit, or at minimum, a clear and believable path toward future profit. Look at how the current valuation compares to that. If a company is trading at an extreme multiple of its current earnings, ask yourself honestly whether you understand exactly why investors believe future growth justifies that price, or whether you're simply trusting that the price going up recently means it will keep going up. The third move is to consider diversified exposure rather than picking individual AI stocks if you don't have the time or expertise to research. individual companies deeply. A technology-focused index fund or broad market index fund gives you exposure to overall economic growth, including the genuine benefits AI will create across the economy, without requiring you to correctly guess which specific company wins this particular technology race. You give up the chance at a massive individual winner, but you also completely avoid the much higher probability of holding one of the many losers. And this one matters more than people think, is to be honest with yourself about your actual time horizon and risk tolerance. If you're investing money you can't afford to lose, money for a house down payment in the next 2 years, money for an emergency fund, money you need relatively soon, speculative high PE ratio technology stocks are not the place for that money, regardless of how exciting the story is. Speculative bets belong in the portion of your portfolio you've specifically decided you can afford to lose entirely without it changing your life. The fifth move is to actually watch what happens during the inevitable correction, because there will be one. Every major technology boom in history, without exception, has experienced a significant correction before the real long-term winners eventually emerged and recovered. The dot-com crash wiped out a huge percentage of internet stocks before Amazon, Google, and others eventually became some of the most valuable companies in human history. The pattern tends to repeat. Hype drives prices far beyond what fundamentals support. A correction happens, often brutal and sudden. The companies with actual sustainable business models survive and eventually thrive. The companies that were purely riding hype with no real fundamentals underneath them disappear or become permanently impaired. If you understand that pattern in advance, you're far less likely to panic sell at the bottom during the correction, and far more likely to recognize genuine long-term value once the dust settles and the winners start to separate themselves from the rest. Here's the thing I want you to really sit with as we wrap this up. The excitement around AI is not misplaced. This is genuinely one of the most significant technological shifts most of us will witness in our lifetimes. But genuine excitement about a technology and sound investment decision-making are not the same skill, and right now an enormous number of people are substituting the first for the second. You don't need to avoid AI stocks entirely. You don't need to be cynical about the technology. What you need is to stop buying based on a label, a recent price chart, or social media hype, and start buying based on actual numbers, actual business fundamentals, and an honest understanding of what you're actually betting on when you click that buy button. Check the fundamentals. Understand the difference between a great technology and a great stock price. Decide how much speculative risk you can actually afford. And remember that every single major technology boom in history has eventually separated its real winners from the hype-driven losers, often painfully, often suddenly, and almost always after the people who didn't do their homework had already lost the most money. If this helped you think differently about how you're approaching AI investments, subscribe because we break down exactly this kind of thing every single week. And if you know someone who's about to throw money at any stock just because it has AI in the name, send them this video before they do it.